For running valuation of bond and stock, we are going to learn about how the interest rate is determined. Also, we talk about the term structure and yield curve. This slide shows the determinant of R. What is R? As we learned before, from future value to present value, we call discounting, right? And it can be calculated by present value is future value over 1 plus I power of n, right? And this I is rewriting with R. So we can rewrite as this. Fv 1 plus R n. And this R is same with this. So we call this as the discount rate on debt. Debt, we also call this a bond. So we can say discount rate on bond. In Korean, 채권 할인율. And when firm issue a bond, it means firm borrow some money. So after that, firm should give interest based on these components. Three components, right? So we call this required return on debt. 채권 요구 수익률 in Korean. And I also called yield to maturity on debt. That means 만기 수익률. It means when investor hold these bonds, investor can expect this amount of interest. And there are three components, the 1, 2, 3. The RRF means the risk-free rate. The risk-free rate has two components, RRF, R star plus IP. IP stands for inflation. R star we called real risk-free rate. It means hypothetically there is risk-free without inflation. And what is inflation? Inflation means how the purchasing power changes based on people's willingness regarding current consumption to future consumption. In the real world, the risk-free rate is proxied by the rate of interest on short-term treasury securities. We usually use the 3 months T-bill of the US government. And next, default risk premium. What is default? At any reason, the company does not make the interest payments of principal. In this case, firm goes to default. In other words, firm failed to pay back borrowing money or interest. They can bankruptcy. Thus, when a firm has a high default risk, then investor require high return. It requires high rate of return. So for the determinant R, important thing is how much of risk that investor take. If there is a high risk, borrower should compensate about this risk to the investor. So default risk premium is high and the required rate of return goes up. So firms should discount more when they issue bonds. And last one is MRP, maturity risk premium. Debt have different maturity that will be 6 months or 1 year or 10 years. So if a firm issue 10-year maturity bond, principal, the 원금, will be paid after 10 years when perm issued. So what is more risk between short-term debt and long-term debt? And long-term debt is more risky than the short-term bond. So if the perm issue more long-term bonds, perm give more maturity risk premium, so the R goes up. We will learn this at the bond valuation part more detail. This slide shows the premium audit for the different type of debt. We have default risk premium and maturity risk premium. And there is treasury bond, which issued by government, and the corporate bond, which issued by firm. Which one has more risk? Based on the relative sense, the long-term corporate bond needs more default risk premium, right? And short-term corporate bond, it also needs default risk. And long-term treasury bond, also it has default risk. But the highest risk is the long-term corporate bond default risk premium. The maturity risk premium, which one has more risk? And long-term treasury and long-term corporate bonds, they have the maturity risk, right? So perm should compensate about this. So the short-term treasury is very less riskier. So it has lowest discount rate. But long-term corporate bonds, it has more default risk and more maturity risk. So perm should discount more. Perm should compensate about this risk to the investor. Perm should give more required rate of return. So highest discount rate. That is the conclusion. This slide shows the term structure and yield curve. What is term structure? Term structure means the relationship between the time to maturity, and yield to maturity, this. So the y-axis is yield on maturity. It comes from here, right? So it can be determined by these three terms: risk-free rate, default risk premium, and maturity risk premium. So in this case, yield to maturity can be calculated by RF, DRP, default risk premium, and maturity risk premium. So the yield to maturity can be rewrite R, right? Discount rate. And the blue line represents what? The blue line we called yield curve. Yield curve is a graph of the term structure. As I mentioned before, term structure is a relationship between time to maturity and yield to maturity. So the x-axis is time to maturity, y-axis is yield to maturity. As you can see, it has positive slope, right? What does it mean? If the time to maturity is high, the yield to maturity goes up, right? What this represents? This represents the maturity risk premium, right? Maturity risk premium. Slide shows the graph illustrating the relationship between corporate and treasury yield curve. As I mentioned before, the term structure, the x-axis is time to maturity, right? So the years is time to maturity, and y-axis is YTM. This y is yield, right? Yield to maturity. What is the relationship between the yield curve of treasury bonds and the yield curve of corporate bonds? These two are corporate bonds, right? And what does it mean? BB and AAA. What does it mean? And this means the credit rating. For example, the Moody's and other company evaluate the firm's default risk, and then they introduce each firm's credit rating. We call that the credit rating agency. Credit rating agency, Moody's and S&P, the other companies. As you can see, BB rated corporate bonds has a more yield to maturity curve, right? It means BB means low credit rating. It means what? High default risk. It means high yield to maturity, high required rate of return. Finally, it should be discount more, right? High discount rate. Yeah, that is conclusion of this slide. Usually, yield curves are the upward sloping, the A type, but sometimes we can see the downward sloping and flat. How can you interpret this and why this happened? There is one theory about explaining this. We call this the pure expectations hypothesis. What is pure expectation hypothesis? To the pure expectation hypothesis, the yield curve depends on investors' expectations about the future interest rate. If the interest rates are expected to increase, long-term rates will be higher than short-term rates. So the slope of the yield curve, it could be anything. So theoretically, it could be anything. There is one assumption of the pure expectation hypothesis. The long-term rates are an average of current and future short-term rates. So if the pure expectation hypothesis is correct, you can use the yield curve to back out expected future interest rates. It is very hard to understand, so let me explain you with example. And this example, the observed treasury yield, it means these maturity bonds, it is traded in the market. So if pure expectation hypothesis holds, what does the market expect will be interest rate on 1-year securities 1 year from now. So let's draw our timeline. Now we want to know 1-year securities 1 year from now. 1 year from now here, right? And 1-year securities, this. But in the market, the bond is already traded, so we already know this 1-year bonds yield. 1-year bonds yield is here, right? So we can write down 6.0%. And 2-year bonds, it is traded at 6.2 years. So 6.2, 6.2. And the solving for this question mark. According to the pure expectation hypothesis, we don't know what this will be right now. We cannot observe. However, we rationally expect this number. According to the pure expectation hypothesis, the 2-year security, 2-year bonds has information about investors' expectation. So we can back out this number using this. So for example, you invest $1. In that case, 1 multiply 1 plus 0.06, right? And then you invest this number, right? And then you get some money. It is same with $1, 1 plus 0.62, compound how many times? 1 and 2. So power of 2. And solving for question mark, that is interest on 1-year securities 1 year from now. We usually write R11 and take a hat because we don't know now. And we also call this 1-year forward rate. This slide shows the previous example. Yeah, this is the below things, right? And this is upper things. What type of average of this? It looks like geometric average. In Korean, 기하 평균. It is not an arithmetic average. Arithmetic average looks like this. Yeah, this is not our case. So when you calculate this, you can solving for x, and finally you get the number 6.4. So according to the pure expectation hypothesis, 1-year securities will yield 6.4% 1 year from now. And calculating x, we called the back out. Until now, people expect this future rate will increase than long-term rate will be increased. Otherwise, expectation can decrease. What happens? Based on pure expectation hypothesis, the slope B or C can possible. In this case, the long-term rate is smaller than short-term rates. In that case, people expect interest rate will be decreased. It's kind of early sign of recession. Let's do our timeline. 0, 1, 2, 3, 4, 5. Now we want to know 3-year securities 2 years from now. So 2 years from now here, right? And 3-year securities. But we don't know the rate. But in the current market, this bond is 2-year bond, right? It's already traded. And this bond is 5-year bond. It is also traded now. So we can write down as this. 1 plus R02, 2-year securities. And when you assume $1 invest today, it compounds 2 times, right? And then 2 years after, you buy 3-year securities, but we don't know the rate. R245 and power of 3 because it compounds 3 times, right? And it is same with when we invest $1 today and then get the money at the maturity, so the 5-year securities. So 1 plus R 0.5 power of 5, right? And as I mentioned before, we already know these numbers because it is already traded in the market. 2-year securities and 5-year securities here, right? 6.2 and 6.5. So we can input the numbers. 1 plus 0.062 square 1 plus R25 power 3 is equal to 1 plus 0.065 power 5, and solving per R25 is the answer. So the usual case R02 2-year bonds can be calculated by R01. It is already traded in the market, and 1 plus R11. In this case we know these numbers, but we don't know this, so we can take a hat, right? So R01, R11 hat, if larger than this, R01, R02. This is short-term bond and long-term rates. In this case, the upward sloping. And this means what? Expected future rate. So expected future rate is larger than the present rate. The slope is upward. The other case, the present rate is larger than the future rate, expected future rate. A short-term rate is higher than long-term rate. It has downward sloping. As I mentioned before, it can be early sign of recession. And the rest case, the present rate is same with expected future rate. In this case, the short-term rate is same with long-term rate. Yeah, it has flat slope. Now flat. Yeah, that is the conclusion of this chapter. So based on pure expectation hypothesis, risk premium is large enough size of the maturity risk premium. In reality, economic cycle overcome the maturity risk. So if we observe the yield curve go downward, that is early sign of recession. Yeah, thank you.